Ask ourselves, what has the globalist economy gotten the United States of America? And the answer is fundamentally it's based on two principles: incurring a huge amount of debt to buy things that other countries make for us. And to make it a little bit more crystal clear, we borrow money from Chinese peasants to buy the things those Chinese peasants manufacture. That is not a recipe for economic prosperity. It's not a recipe for low prices, and it's not a recipe for good jobs in the United States of America.
In just 24 hours, China slapped a 125% tariff on American goods, canceled a $400 million Boeing contract, and caused the U.S. luxury market to lose billions in value. What happens when a politician slips with words, and the global economy pays the price? Is this the perfect example of the phrase, open mouth, insert foot, that Americans often joke about? Recently, U.S. Vice President JD Vance referred to Chinese workers as peasants. Though perhaps meant as a colloquial phrase, Beijing took this as a direct insult to their labor force, a group China holds as a pillar of its national growth. But the response was not just words or media statements. It came in the form of hard policy. China imposed a 125% tariff on U.S. goods, with no prior warning. They canceled Boeing orders worth $400 million, a heavy blow to America's aviation industry. And they halted all mail and cargo shipments from Hong Kong to the U.S., causing supply chain blockages. China's swift, decisive, and uncompromising moves show they are not just defending pride, but using the incident to reassert their position in the simmering trade war. Right after China's tariff retaliation, Chinese consumers responded with their wallets. This battleground wasn't in agriculture or technology, but in luxury goods. Gucci saw a 30% drop in market value in the first quarter alone. LVMH lost over 2% in market cap overnight as sales stalled in Asia. High-end stores in Shanghai and Beijing, once bustling with thousands daily, are now unusually empty. On Chinese social media, Western brands are labeled betrayal brands. Shopping stopped being personal. It became a collective statement. Rather than taxing individual products, China succeeded in weaponizing consumer emotion, a soft but extremely powerful tool. While policymakers debate tariffs' pros and cons, Americans see the impact firsthand. Food, household goods, and electronics prices have risen significantly in recent quarters. Walmart warned it can't hold prices forever amid rising import costs. Some imported medicines, like ibuprofen, are becoming scarce due to supply disruptions from China. A survey by Allianz found nearly 60% of Americans believe the trade war is harming more than helping. The impact isn't limited to domestic markets. The U.S. faces subtle shifts from international partners. India remains cautious, refraining from openly supporting either side, instead focusing on strengthening bilateral relations with both. The European Union threatens retaliatory tariffs worth €95 billion if the U.S. escalates tariffs unilaterally. Canada quietly raised tariffs by 25% on American cars and is pushing trade talks with the EU. Meanwhile, China pursues a different path, restructuring supply chains, focusing on domestic market growth, encouraging citizens to buy local instead of foreign brands. And most importantly, China doesn't just talk policy, it shapes global policy through consumer behavior. After intense pressure from businesses, markets, and public opinion, both sides agreed to cool down. The U.S. cut tariffs from 145% to 30%. China lowered its tariffs from 125% to 10%. The bigger questions remain. Supply chains are broken. Who will rebuild them? Trade trust is damaged. Who will restore it? Tariffs can change, but markets have adapted, consumers have shifted, and partners are charting their own courses. Reducing tariffs is necessary, but restoring trust requires more than a decree. It demands a long-term strategy.
The international credit agency Moody's downgraded the U.S.'s credit rating from its highest AAA rating to AA1.
Rick, there are so many things that are swirling around this. We know about the Moody's downgrade. We know that that raises some concerns about
budget. I would hope that the Moody's message and some of the agita that the media expressed when it occurred.
Did you know? The U.S. government's annual interest expenses have soared to a staggering $870 billion. And Moody's just downgraded America's sovereign credit rating from AA to AA1, the last step before losing top-tier status altogether. What do you think this signals for the world's largest economy? U.S. credit downgrade and debt inflation strategy. In May 2025, Moody's downgraded the U.S. credit rating. Why? Because interest costs are soaring, expected to consume nearly 30% of the federal budget by 2035. Triple today's share. Imagine how much is left for education, healthcare, and development with such huge interest payments. The Treasury Secretary announced no spending cuts but plans to let inflation erode the debt. Sounds clever, but risky. Real GDP growth is only 1.1%, while inflation hits 4.2%. This means bondholders get paid, but the real value of the dollar is shrinking. Confidence in U.S. bonds may waver, pushing yields up and making borrowing ever more expensive. This could be the vicious cycle America is facing. Rising bond yields, USD decline, and China's retreat. Long-term bond yields have surged past 5%, folks. This shows growing investor anxiety. They demand higher returns to protect their money from losing value. Did you know? In just 1 month, the US dollar has lost nearly 4% of its value. A shocking figure. This not only spikes import costs, but also pushes domestic inflation higher, putting huge pressure on consumers and the overall US economy. Even more surprising, China, the US's largest creditor for 20 years, is quietly pulling back. They've slashed their US bond holdings to $765 billion and shifted to short-term investments to avoid long-term risks amid global turmoil. What if other investors follow suit? The US bond market would face massive pressure, yields would skyrocket, and borrowing costs for the US government would spiral out of control. This could force budget cuts on vital programs or tax hikes, directly hitting economic growth. But it doesn't stop there. This mass retreat could trigger a domino effect, shaking the entire global financial system. Not just the US, but the whole world would feel the impact. Do you think the US can escape this dangerous spiral? Or is this the warning sign of a new global financial crisis? Gold prices surge, allies reject trade demands, and Fed may need to intervene. Gold prices have soared past $3,200 per ounce, with experts forecasting a rise to $4,000 by 2026. This clearly signals investors seeking safe havens away from US dollar risks. As for trade allies, they're no longer accepting tough demands as before. These shifts erode trust and create turmoil in international markets. So, the big question: who will buy new US debt if this continues? If countries stop buying, the Fed will have to step in, buying government bonds to stabilize the market. But you know what that means. More money supply, heavier inflation pressure, further dollar devaluation, and a threat to America's global economic standing. Do you think the US can escape this predicament? The Abe credit rating, the symbol of financial safety, is now gone. Bond yields are rising sharply, inflation outpaces real growth, and major investors like China are steadily retreating from the US debt market.
Did you know BYD sold over 4.27 million vehicles in 2024 alone? That's a global phenomenon, reshaping the automotive landscape worldwide. Meanwhile, in Canada, more than 125,000 auto workers are waiting for a miracle as major U.S. automakers begin to pull back from the region. In January 2025, the United States officially imposed a 25% tariff on all imported vehicles. For Canada, the rate is only 12.5%, but this comes with strict and complex conditions. Vehicles must have a high percentage of North American-made components to qualify. This is easier said than done, especially for highly integrated global supply chains. Immediately, automotive giants like GM, Ford, and Stellantis began scaling back production activities in Ontario. While not a full withdrawal, this resulted in fewer shifts, reduced output, and temporary layoffs that have placed workers in a difficult situation. Imagine Ontario, Canada's auto heartland, now struggling to keep pace due to policy changes just across the border. This has created a ripple effect through the local economy, impacting not only workers, but also small businesses and supply chain partners dependent on a vibrant auto sector. In light of these challenges, Canada has started to look beyond traditional partnerships. Enter BYD, China's electric vehicle giant. BYD is actively negotiating plans to open a manufacturing plant in Ontario. Other Chinese automakers like NIO and Geely have also been mentioned as pursuing R&D operations in Quebec. Imagine a Chinese EV factory emerging right in the heart of Canada's automotive territory. But there's more to this story. China needs critical minerals such as lithium and cobalt, plus access to clean energy resources, many of which are abundant in Canada. Canada, in turn, needs job creation, foreign investment, and a new industrial strategy after facing setbacks from U.S. companies' retreat. This appears to be a mutually beneficial exchange on the surface. Yet the situation is more complex and fraught with challenges than it might seem at first glance. For instance, integrating Chinese technology and capital into Canadian industries raises questions about long-term control and influence. Predictably, the reaction from Washington has been sharp and unmistakable. White House advisors have raised concerns that allowing Chinese firms to deepen their roots in North America's EV sector would effectively mean handing over crucial technology to a strategic rival. Electric vehicles today represent more than just transportation. They symbolize control over energy, dominance of supply chains, and broader geopolitical power. If Canada proceeds down this path, it risks becoming a key hub for Beijing's strategic expansion into the Western Hemisphere. The growing presence of Chinese corporations in such a critical sector fuels American concerns about potential technology leaks and loss of control over essential manufacturing processes. These issues extend well beyond economic competition. They touch on national security risks that policymakers cannot ignore. The U.S. government is closely monitoring developments, warning Canada of the strategic implications and urging caution in this evolving partnership. If the deal comes to fruition, a BYD manufacturing plant in Ontario could create between 2,000 and 5,000 direct jobs. Additionally, suppliers of batteries, semiconductors, and other high-tech equipment could experience significant growth opportunities along the expanded supply chain. Ontario could be transformed into the new Detroit for electric vehicles, this time powered by clean energy rather than fossil fuels. However, these bright prospects come with risks that cannot be overlooked. Canadian businesses may face the loss of decision-making power as they become intertwined with larger Eastern production networks. Smaller domestic companies could struggle to compete against heavily backed Chinese conglomerates with strong government support. Striking a balance between economic benefits and strategic autonomy is the biggest challenge Canada faces in this rapidly evolving landscape. With China's influence expanding and the U.S. government pushing back firmly, Canada must carefully weigh the costs and benefits of this pivotal move. The stakes have never been higher for the Canadian automotive sector, and the decisions made today will shape the industry's trajectory for decades.
Trade officials from both countries were in Switzerland for a series of discussions this weekend.
Has it been a huge day in the world of money, power, politics?
Okay, more now on the trade tensions, and the companies in the US are rushing to get shipments.
The United States and China have sought to end their trade war for now by agreeing to dramatically slash the tariffs.
双方已经刚刚发布了会谈达成的联合声明。
We have reached an agreement on a 90-day pause.
The U.S. once imposed tariffs up to 245% on Chinese goods, and China retaliated with 125% tariffs on American products. Now, both sides have agreed to cut tariffs by 115%, down to about 10% over the next 90 days. What is happening? The tariff reduction agreement between the U.S. and China. After years of escalating tariffs that froze trade between the U.S. and China, this mutual tariff cut signals that both sides want to avoid further damage. The previously high tariffs had driven up prices sharply, disrupted global supply chains, and directly affected businesses and consumers. Now, the tariff cuts help reopen trade channels, reduce transportation and production costs, thereby speeding up the flow of goods and supporting the recovery of the economy and the global supply chain, which has been under great pressure. This could be the starting point for the world's two largest economies to move toward a more stable phase of cooperation instead of prolonged confrontation. Background, reasons, and objectives of both sides. Before the agreement, the tariff war between the U.S. and China had wide-reaching impacts. The U.S. imposed high tariffs to limit cheap Chinese goods, aiming to protect domestic manufacturing and reduce a trade deficit worth hundreds of billions of dollars. In response, China retaliated with tariffs that sharply increased the cost of imports from the U.S., putting pressure on consumers and businesses in both countries. For China, a real estate crisis and rising unemployment have added stress to its economy. Meanwhile, American citizens have suffered from rising living costs as imported goods became more expensive due to tariffs. Additionally, China worries about being isolated from global supply chains as the U.S. signs new trade deals with other partners. Although the tariff reduction is a positive sign, economic and policy conflicts remain, making future cooperation challenging. In this complex context, can both sides find common ground to build a stable and sustainable trade relationship? Impact on people in both countries. High tariffs have pushed the prices of many imported goods to uncomfortable levels, ranging from electronics and clothing to essential food items. Consumers in both the U.S. and China have had to spend more on familiar products, increasing financial pressure on household budgets and negatively affecting quality of life. The tariff cuts will help ease prices, making goods more accessible and reducing financial strain on people. Furthermore, lowering tariffs will help businesses reduce production and raw material import costs, maintain employment, and stabilize the labor market. However, the actual benefits reaching consumers may not happen immediately and will depend on factors such as company pricing policies and the global market situation. Future outlook and challenges. The tariff reduction agreement is only effective for 90 days, serving as a trial period for both sides to assess cooperation levels. This is a positive sign, showing that both the U.S. and China want to temporarily set aside disputes to stabilize trade. However, many core issues such as trade balance, intellectual property rights, and industrial policy remain unresolved. Whether the global supply chain can sustainably recover depends on the ability of both sides to continue negotiations and build long-term trust. Otherwise, tensions could flare up again, bringing many negative consequences for the global economy.
Well, it is going to be crushing. He sparked a trade war. I talked to farmers who are still digging out from the tragedy that was, and now they're looking at it again.
Right. Are you angry?
It's difficult to be angry on somebody else's behalf.
So it's not about you, it's not about your farm and the fact that you bought a farm to avoid inheritance tax.
But as we think about the farmers and the headwinds that they face, I can think of a number of them. Fertilizer costs, fuel costs, labor shortages.
$27 billion is the value of U.S. agricultural exports to China in 2024. But in just 1 week, soybean exports dropped 50% and pork fell 72%. Why is this largest market pulling back? What consequences will American farmers face? The hardship of American farmers and China's strategic shift. In 2024, China imported $27 billion worth of U.S. agricultural products, making up the majority of the country's total agricultural exports. However, as tariffs increased sharply, everything changed rapidly. Within a single week, soybean exports to China fell by 50% and pork by 72%. This is not just a number. It represents a real crisis for American farmers. Inventories piled up unsold, prices plummeted, forcing many to suffer heavy losses and even face bankruptcy risks. Why did China withdraw? They quickly shifted to other partners. Brazil became the new largest soybean supplier, with forecasts of over 31 million tons imported just in the second quarter of 2025. China also invested heavily in Brazil's port infrastructure and signed long-term contracts with Argentina and several other South American countries. This is not a temporary reaction, but a long-term strategy to reduce dependence on U.S. agricultural products. Impact in the U.S. and political reactions. The direct consequence of losing the Chinese market is massive economic damage on U.S. soil. In states like Iowa, farmers reported losses of more than $25 per acre. Total damages run into millions of dollars regionally, severely affecting the livelihoods of thousands of families. Not only farmers, but related industries, such as agricultural equipment, feed stores, and machinery repair services, are also seriously impacted. Many small businesses are forced to scale down and workers are laid off. Politically, pressure from this crisis is causing lawmakers to consider proposals to limit the president's unilateral tariff powers. The goal is to avoid uncontrolled market fluctuations that severely harm agriculture. widespread discontent among farming communities is strongly shifting voting trends in traditional agricultural states, opening new political developments, new development strategies, and the future of American agriculture. Facing major disruptions from the Chinese market, American farmers and policymakers are beginning to explore new directions to reduce this dangerous dependency. One key strategy is diversifying export markets. Southeast Asia, Africa, and Latin America are seen as rapidly expanding potential markets with growing demand for agricultural products. Developing these markets not only reduces risks, but also opens opportunities for sustainable growth of U.S. agriculture in the long term. Moreover, the agriculture sector is focusing on investing in value-added products and food processing. Instead of only exporting raw materials, developing processed products with higher economic value will increase profits and competitiveness globally. Technology also plays a critical role. Applying modern supply chain management technologies like blockchain helps ensure product origin and quality, while enhancing operational efficiency and transparency in international trade. The future of American agriculture requires a stable multilateral trade strategy that avoids volatile tariff policies. Innovation in technology and market diversification are the keys to maintaining competitiveness and sustainable development amid today's complex geopolitical environment. April 2025, a cargo of 300,000 tons of soybeans arrives at a Chinese port. All documents say product of Argentina. But within 48 hours, the entire shipment is rejected. Why? Because it was U.S. soybeans wrapped in a South American disguise. The discovery that shook global markets at Tianjin Port, one of China's largest agricultural import hubs, a cargo ship carrying 300,000 tons of soybeans from Argentina docked in April 2025. All the documentation appeared legal, clearly stating the origin as Argentina. But when samples were tested, an anomaly surfaced. The protein content was 35.1%, much higher than the typical threshold for Argentine soybeans, which rarely exceed 34%. Moreover, the sacks carrying the soybeans bore manufacturing codes traced back to plants in Iowa and Minnesota, USA. In less than 48 hours, Chinese customs returned the entire shipment. A brief but sharp statement followed. The cargo shows inconsistencies in origin. Suspected to be of U.S. origin, it wasn't the first time, but it was the largest case ever recorded. And the market reacted immediately. U.S. soybeans take the back door, a cycle of deception. Since 2024, trade tensions between the U.S. and China have surged. Tariffs on Chinese goods entering the U.S. rose to 145%. In response, China slapped duties on various American exports, including soybeans, a core agricultural product. For American farmers, this was a crushing blow. China has long been the world's biggest soybean buyer, consuming over 100 million tons per year. In the past, the U.S. supplied over 36 million tons annually. But by 2024, that figure dropped to just 22 million tons, a 40% decrease. To bypass tariffs, some U.S. exporters turned to re-exporting, shipping soybeans to Brazil or Argentina, rebranding the packaging and documents, and then selling them to China under a third country label. This tactic isn't new, but it has grown more sophisticated, blending complex shipping logistics, forged certifications, and falsified biological profiles. The 300,000-ton shipment rejected in April 2025 was more than just a random inspection. It was a direct strike on a growing practice of loophole trading in the global agriculture sector. How China unmasked the fraud with traceability tech. Since 2024, China has upgraded its product origin verification system using blockchain, protein analysis, deep learning AI, and GPS vessel tracking. At major ports like Shanghai, Tianjin, and Shandong, all imported agricultural goods are randomly analyzed by systems boasting up to 98% accuracy. Just in Q4 2024, 3 soybean shipments worth over 20 million yuan, labeled as Brazilian but biologically consistent with U.S. beans, were intercepted and returned. Even a small price gap between Brazilian and American soybeans, less than 5%, would trigger an automated alert, leading to on-site inspection. China, in coordination with Brazil and Argentina, implemented a birth certificate system for every soybean batch, including region code of plantation harvest date, shipping route, blockchain-based invoices and documents. This technological wall makes it nearly impossible for fraudulent cargo to slip through undetected. A double blow. US pays the price. Argentina takes damage. When the shipment was rejected, China didn't just return the beans, it suspended new contracts with multiple Argentine exporters. According to reports, China accounted for 70% of Argentina's total soybean exports in 2024. This incident alone cost Argentina over $200 million just in Q2 of 2025. The scandal forced the WTO to hold an emergency session in Geneva in December 2024, aiming to draft a new global standard for origin verification. In this geopolitical tug-of-war, countries in the middle, like Argentina, became unwilling casualties. Just one tweet, and Trump made $25 billion evaporate, sending the U.S. economy into a roller coaster, reducing tariffs on China from 25% to 10%. Genius or disaster waiting to happen? On May 9, 2025, the 30-year U.S. Treasury bond auction failed spectacularly. Yields shot up to 4.9%, the highest this year, causing investors to flee. Demand from foreign buyers dropped to just 57%, compared to 63% just 6 months ago. Our close allies like Japan and the EU looked at the growing $35 trillion national debt and shook their heads. No thanks, they seem to say. The real question is, who's going to pay for this massive debt party? As the U.S. national debt continues to skyrocket, the growing lack of confidence is palpable. Foreign investors are increasingly worried that the U.S. government won't be able to maintain financial stability without drastic changes. The rising yields reflect this skepticism, signaling that even the U.S.'s closest allies are unsure about continuing to invest in the country's future. It's becoming clear that the U.S. may face a financial reckoning sooner than expected. With growing uncertainty in global markets, the question remains, how long can the U.S. continue to borrow at these levels without facing dire consequences? Like a Hollywood director, Trump threw in a plot twist that left Wall Street stunned. With just one late-night tweet, he announced the reduction of tariffs on China from 25% to 10%. No meetings, no press conferences, just a tweet. Even Secretary of Treasury Scott Bessent was caught off guard, looking more like a horror movie spectator than a government official. Trump's team, used to his Twitter-style decisions, couldn't help but exclaim, "Boss, this one's a bit much." Strategy? Maybe, but it looks more like, let's see what happens. This sudden announcement caught everyone off guard, especially investors who rely on stability in trade policies. It wasn't just a change in tariffs, it was a shift in how the U.S. government handles trade wars. The lack of official discussions or briefings left the markets feeling uncertain and confused. Was this an attempt to smooth things over with China, or was it another impulsive decision that could backfire? The reduction of tariffs could be seen as an effort to calm down inflation, but it also raised concerns about the U.S. government's ability to make coherent decisions in the midst of a trade war. If one tweet can change the course of a key economic policy, how much trust can investors place in the U.S. government's trade agenda? What seemed like a lifeline turned out to be pouring fuel onto the fire. Chinese goods flooded the market, but U.S. inflation spiked by 0.8%. According to Goldman Sachs, the cost to borrow for the U.S. government shot up, and now the $35 trillion debt feels like a balloon ready to burst. Americans, already struggling with high costs, now face the additional burden of paying interest on the national debt. Trump's tariff strategy, once hailed as "Make America Great Again," is now more like "Make Americans Pay Again." While the U.S. is struggling, China is playing trade chess like a grandmaster. They've bypassed tariffs by rerouting goods through countries like Vietnam and Thailand, leaving the U.S. with nothing but the shadow of the trade war. China's exports to the EU and ASEAN jumped by 15%, while the U.S. remains dependent on 78% of rare earth minerals from China, according to USGS 2024. The electric vehicle and defense industries in the U.S. are crying for help, but the supply chain remains a tangled mess. Trump wanted to decouple from China, but it turns out the U.S. is the one stuck. The U.S. is now considering lowering tariffs to just 5% to salvage the situation, but experts warn this could lead to inflation rising another 0.5% and global trade losing $300 billion per IMF. Meanwhile, China, with a victorious smile, is not rushing to make any concessions. Investors are standing on a powder keg, ready to pull their money out if the White House keeps playing the tweet and hope game. Will Trump turn things around, or is this the uncontrolled crash of the U.S. economy?